이번 순서는 블루스트림사의 CEO시죠. 샘슨 모 CEO님께서 발표를 준비해 주고 계시는데요. 지금 무대 뒤편에서 말씀을 나누고 계시네요. Cryptocurrency vs Token Economics라는 주제로 발표를 해 주시겠습니다.
Hello, everyone. First, I'd like to say thank you to Block Media for inviting me to speak at BLOCKFESTA 2018. It's great to be here, and today I'd like to share with you a presentation on cryptocurrencies and token economics. So exactly as the title says, I'm going to kind of break down how cryptocurrencies are different from tokens and the kind of things that you want to look at to analyze. So some background about myself. My name is Samson Mo. I'm the Chief Strategy Officer at Blockstream. Previously, I was the COO at BTCC. It's one of the largest exchanges and mining pools in the world. And before that, I was at Ubisoft as a director of production working on games. So I'm a Bitcoin enthusiast, and I've been known to make some crypto-themed hats. So a little bit about Blockstream. Blockstream is a blockchain infrastructure company. We're primarily focused on working on Bitcoin. We were founded in 2014, and we're a very distributed organization. We have people all over the world. Our main offices are in the Bay Area, Victoria, BC, Canada, and we just set up a new office in Milan. So we're kind of all over the place. We've raised about 80 million from our seed round and Series A. And yeah, I'll talk about some of the things we do. So a lot of things we do are related to infrastructure. So in terms of scaling and strengthening Bitcoin, that's mainly our focus. So we have Blockstream Green Address. It's a non-custodial two-factor wallet. We have Elements. It's a blockchain platform. So it's open source repository where we do most of our R&D, and everything is open source. So if you want to build your own blockchain, you can take our Elements code and work with it. A lot of people are already using Elements to build things. We also contribute to the Lightning Network. So we were actually one of the first to invest in R&D on Lightning. So I think we started back in 2015. So our focus is generally very long-term, and we're looking ahead to where all this technology is going. But we're one of 3 implementations. There's Blockstream with C Lightning, there's Lightning Labs with LND, and there is Async with Eclair. So all 3 implementations are compatible. And finally, the most interesting one, I think, is Blockstream Satellite. So this is a satellite service that's beaming Bitcoin blocks using leased space on geosynchronous satellites. Those are about 30,000 kilometers out from the Earth. So large commercial satellites. And we're going to announce full worldwide coverage pretty soon. But it's an interesting project because you can essentially get the entire Bitcoin blockchain for free as long as you have a satellite dish. So our 2 main flagship products are Liquid. It's an inter-exchange settlement network. So it's a side chain that we've developed based on the white paper, the two-way federated peg white paper that we founded Blockstream on. And it's essentially a way for traders to move money, institutions to move money quickly to different venues and take advantage of arbitrage opportunities. But it also has another interesting functionality, which is issued assets, which allows you to issue tokens on this Bitcoin sidechain. And we have our cryptocurrency data feed. This is a project that we're developing in partnership with ICE. ICE is the owner of the New York Stock Exchange, and recently you may have seen the news that they launched BACT, which is a digital asset exchange. But the data feed is essentially what it says. We're collecting data from 15 exchanges and 133 pairs, and we're pulling in about 200 million data sets every day and pushing it through to this feed. But this is a way to get institutional money into cryptocurrencies because they want that transparent and reliable data. So my presentation is broken up into largely 2 parts. The first part is understanding tokenomics, token economics, and the second part is looking at meaningful metrics of how to evaluate cryptocurrencies. So understanding tokenomics. A lot of people are very interested in tokens right now, and that is understandable given the media hype and everything, but it's important to distinguish what a token is compared to a cryptocurrency. So there's 3 main points that set them apart. The first one is that a cryptocurrency typically has decentralized control. meaning that no one is in control of the currency or the protocol. However, a token is generally centralized. It's typically controlled by a single company or a group or a foundation to kind of abstract that control away from the development team, but it's still a centralized offering. And the best way, I think, to think about a token is that it's really a company, and you're kind of buying a stock in the company, but not really. So coin generation for cryptocurrency is open to all. So if you're a miner and you want to mine Bitcoin or Litecoin or anything, you can do so. But with a token, it is centrally issued. So not everyone can participate in the token generation. So you're just buying something that was produced for you. Cryptocurrencies are typically a standalone economy, meaning they're not reliant on anything else. So Bitcoin, Litecoin, and those kind of cryptocurrencies or Monero, they're all independent and they have their own blockchain. Whereas a token is reliant on an underlying platform to derive its security. So a typical token would be ERC20, and that's deriving security from the Ethereum blockchain. So for decentralized control, users can determine the protocol changes. So this is a chart showing Bitcoin nodes signaling. So this was a critical part in Bitcoin's history, which was the BIP148 or UASF, user activated soft fork, where the users actually help push along a network upgrade to SegWit. And this would not be possible in a token, but it is possible in cryptocurrencies. You can also have users signaling to reject changes too. So there was a SegWit 2x proposal, and the community essentially rejected that with the No 2x campaign. And then there was Ethereum Classic, which was rejecting the Ethereum hard fork to bail out the DAO. So with a cryptocurrency, it is possible for the average person or user of the currency to affect change. So the properties of a cryptocurrency also means that coin generation is open. So for Bitcoin, you can actually mine it. If you buy some mining hardware, you can participate in in the coin generation. You can see that these are different mining pools, and it is actually relatively decentralized. Pools themselves are kind of clustered around a few large ones, but anybody can come and join and leave a pool on their own volition. So it is quite decentralized, and a lot of mining farms are quite small. So you might have a lot of smaller scale miners making up one larger pool. So the properties of a token means that it is essentially generated. So Ethereum, they pre-generated 12 million Ether for development, and they gave that to the Ethereum Foundation. Neo generated 50 million, but this model is very common for ICOs. And if you compare the top ranked coins on CoinMarketCap, 8 of the 12 were actually insta-mined or pre-generated. Things like Bcash did not start from zero. It had a price at launch because there was a futures market, basically guessing at the price, and so forth. But a lot of them are not mineable. But despite all of that, Bitcoin is still number one. So let's talk about the reality of token ownership. I mentioned that having a token is like owning shares in a company, except for it's not. So token ownership exposes you to dilution because they're centralized. Someone can issue more tokens at any given time. There are backdoors. A lot of people are not capable of auditing a smart contract for some of these tokens, so they have no idea about the vulnerabilities that they're getting into. And you're exposing yourself to potential penalties if it's a security. And that's a quote from the SEC chairman, which says, "I believe every ICO I've seen is a security." So unlike a stock, token ownership does not give you any say in how a company is run. It does not entitle you to any profits of the company, and you have no legal recourse. So for the case of Tezos, they actually called their investors donations or contributions donations, and you're waiving any class action rights. Also, going to the point about security of some of these smart contracts, this is a backdoor in CryptoKitty. So any C-level executive in this company can actually pause that smart contract, meaning it's very, very centralized. Augur has an escape hatch that they can call to essentially claw back Ethereum or REP in an emergency. So if you're buying a token and you expect that it's like a cryptocurrency, then you're in for a rude awakening. So another thing people like to do is treat tokens as a speculative instrument, which means they want to invest when it's cheap and sell when it's high. And just a disclaimer, none of this is investment advice. But it's actually very hard to accomplish that. So the odds of selling at the all-time high are very, very low unless you are a trader and that is your full-time job. So Ethereum's all-time high lasted 4 hours and Ripple XRP lasted for 1 hour. So you can try your luck, but buying low and selling high does not work fundamentally because these are very volatile and you're probably not going to catch it. So tokens, they typically reach high prices, popularity, and then they decrease in price and awareness. So in 6 years of history, XRP spent less than 3 weeks above $1.50. And that was actually probably the point when most people heard about XRP because it started making the rounds on the news and things like CNBC started teaching people how to buy it at $3. But most people probably bought at the top and sold somewhere along the bottom. And you can see this is a Google search interest for the past year, but you can see that the interest kind of coincides with these price spikes actually very well. This is a chart created by Willy Woo. He's an analyst that looks at cryptocurrencies. But you can see the value of altcoins relative to their day one trading price. So the price multiplier along the Y column is essentially what price it launched at. And if it's $10 later, then the multiplier would be 20. But it's just an easier way to measure it. But you can see over time, everything kind of trends down, except for Bitcoin, which is that orange line well, at the top. And you might think that that small blue line in the top left corner is Ethereum, but it's not. It's actually a statistical aberration. It's some token called game, but it's not normal. So there's also the concept of diversified portfolios when people talk about investing in tokens. And unfortunately, diversified portfolios don't actually work. So this is a chart showing if you bought Bitcoin a year ago, so August last year, you'd be up 54% today. If you bought into the concept of a diversified portfolio and you bought the Coinbase index fund, you'd be up 37%. But that chart over here on the far right shows that if you took Bitcoin out of that portfolio, or that basket, you'd be down 6%. And if you bought the top 10 coins, if you split your money evenly amongst the top 10 or top 16, you're actually far much worse off. So the key message here is that the more diversified you are, the worse off you're going to be. And the reason for that is because tokens and cryptocurrencies are highly correlated with Bitcoin. So you can see all those the red area of that chart there, that just shows high correlation. The higher the number, the closer it is to 1, the more correlated that is. And then the blue and beige are non-cryptocurrency assets, so like the S&P, gold, and such. But if you want to diversify, you cannot diversify into other cryptocurrencies. It just does not work that way. And that is because Bitcoin is essentially digital gold. Its key value driver is digital scarcity. So if you have people copying that coin, like a lot of the fork coins and altcoins are doing, then they're not very digitally scarce, and it kind of eliminates that value proposition. So this is just showing one of those baskets, but you can see it's like BCH, ETH, LTC, and I think not ETC, but everything kind of follows Bitcoin. So Bitcoin is the yellow line at the top. It actually ended up better off than everything else, but everything does correlate, but there's more volatility. But in the end, ultimately over time, you can see it does not work out that well. So this is CoinMarketCap in 2013, and it's almost unrecognizable from today. I don't think anyone here can recognize any of those other coins except for the top two, which are Bitcoin and Litecoin. So it just goes to show, over a long enough time frame, you can see that everything has very poor performance relative to Bitcoin. I think I would criticize Mr. Weiss and that Weiss score system. Unless Bitcoin is A+ rating, I would question that entire system because you just have to look at the numbers and facts. So nearly half of all 2017 ICOs have failed. We can see on this chart the pink and blue dots means failure, and that's quantified by not meeting their fundraising targets, or the project just evaporated, meaning team is gone, the websites, Telegram groups, and everything have disappeared. And even in 2018, we have seen 20 ICOs fail. So I guess in closing for that section, it's not really a good idea to bet against things like Bitcoin or even cryptocurrencies. Tokens are kind of a second-class citizen in this space, in the cryptocurrency space. So let's talk quickly about meaningful metrics for looking at cryptocurrencies. I think any system that is evaluating cryptocurrencies should factor in these things, but a lot of them are more technical, so it's unlikely that people looking at cryptocurrencies or investing in cryptocurrencies have the capacity to make that evaluation. But if you look at security, it's really key because all these cryptocurrencies, they're just data. It's just code, and it's publicly available. If it's permissionless, then anybody can participate in the network. And like you see with Ethereum's parity wallet, you can essentially brick the wallet and freeze funds for everyone. It's not a stock, and it's not safe in any way. It's just code. So if you have these kind of security vulnerabilities, which a lot of the top currencies do, you're not going to have much luck. So recently there was a critical bug discovered in BCH, which would have caused a chain split, which would probably have tanked the price. And it was not their developers that found it. It was Bitcoin developers that found that. So that leads me to my, next point. So mining is another thing you need to look at, which is how hard is it to attack a cryptocurrency? It's not a stock, it's not an asset. You have to think of this as code because it is code. And a lot of these mineable cryptocurrencies, they can be very easily attacked. There's a website called 51crypto.app, and it coined a term called nice hashable. Nice hash is a website where you can rent hashing power. And nice hashable means you can rent hash power to 51% attack a lot of these cryptocurrencies. And that means you're going to essentially steal money from exchanges or double spend transactions. But the cost to defend against that is very, very diminished as you move down the food chain. Bitcoin is quite secure. To buy enough hardware to 51% attack, you need $5 billion. Ethereum is $7 billion because they're GPU mined, but now they have ASICs, so that number is going to be calculated differently. But you can see Litecoin, it goes to 0.7, Zcash to 1, and then Bcash 0.2, which means that a lot of these currencies, especially the smaller ones, are very, very prone to attacks. Another important metric is looking at development activity, because who's going to keep a cryptocurrency safe? It'd be the developers working on that cryptocurrency. And you can look at GitHub to kind of analyze this and break it down. But Bitcoin is the most active project, bar none. A lot of projects have no development activity, which means nobody's looking at improving the protocol, improving the software, and looking at bugs. Bitcoin is actually highly secure in this regard because there are hundreds of developers working on it. Also, the next thing I want to point out is adjusting for unit bias. So this is similar when you go to a store and you're buying something and they mark it down to like 99 cents. Because psychologically you think 99 cents is cheaper than $1. And that's the problem a lot of people have when they're looking at cryptocurrencies, because not everything has a hard limit or a small hard limit like Bitcoin. So everyone knows Bitcoin has a 21 million cap, and the current circulation is 17.2 million coins. But how can you compare to some of the cryptocurrencies with billions in circulation and printed with no cost? You have to first adjust for unit bias. So if you actually take the market cap of some of these divided by 17.2, you can see everything is very expensive. A lot of people will buy things like Ripple or new projects that come out thinking they're cheap. It's 20 cents, and I can just put a little bit of money in, and that 20 cents will go to hundreds of dollars later like Bitcoin. No, that's not going to happen, because you're actually buying Ripple at $750. You're buying EOS at $253. Tesla stock is like $300, $400, and all of these have no use. So a lot of people are going to get caught up in unit bias and think that I'm buying something valuable when it's largely not the case. So in closing, tokens have fundamentally different properties than cryptocurrencies. They don't represent ownership or any entitlement in the company or project. Successful speculation is much, much harder than it looks. You're probably not going to replicate buying Bitcoin at pennies on the dollar. Diversified portfolios don't really work at all. The more you diversify, the worse off you will be. You have to look at security track records, hash rate, developer activity to see if anyone's actually working on this thing. And you need to be mindful of how unit bias will factor into your decision as well, because it can be very, very, very misleading. So this is a slogan that we like to use at Blockstream: don't trust, verify. It's talking about running a Bitcoin full node, which you can run and verify everything on the blockchain. But it applies to this as well. All of the data that I presented is publicly available, so you can do your own research and verify for yourselves. That's it for my presentation. Thank you very much.